Welcome to Wealth Wisdom. If you have ambitions to achieve financial success, please leave yes in the comment, and we are here to help you obtain insight and build wealth. The book we are going to share today is Financial Intelligence by Karen Berman and Joe Knight. What's in it for me? A crash course in cash. Intelligence, you're either born with it or you're not. But financial intelligence is different, it's something anyone can acquire. It doesn't matter if you're inexperienced with numbers, or if the sight of a balance sheet makes you break out in a cold sweat. These are things you can learn. And they're worth learning, particularly if you're a manager or a decision maker at your company. If you understand how to measure financial success, you can make better decisions and help improve the company's results. You'll also feel much more confident in your own abilities. Of course, we can't cover all aspects of finance in this short chapter. But we'll give you a crash course in cash, why it matters, and how to interpret cash flow statements. Before we continue, if you are interested in this topic, please consider subscribing and give us a thumb up. Let's continue. Companies need cash, not just profit. One day, an executive at a Fortune 100 company received a request from a client who had a credit line of $100 million. Could the company send the client the funds? For a big corporation, this was a pretty standard request. But when the executive talked to the treasury, she was shocked by what she discovered. They didn't have the funds. The company had run out of cash. This story goes to show that even big companies make basic mistakes, and it's a surprisingly common issue. So many managers fail to pay attention to cash. People who are financially intelligent understand just how important cash is. Take Warren Buffett, for instance, perhaps the most successful investor of all time. When Buffett looks at financial statements, he pays close attention to cash flow and owner earnings. That's a valuation of how much cash a company can generate over time. Remember, companies need cash to stay alive. Profit is all very well and good, but you can't use it to pay for computers and other supplies. In order to pay for things, you need cash, real money. So, if you want to be financially intelligent, you should keep an eye on cash flow. Think of cash as a reality check, an insight into how the company's really doing right now. Also, if you understand cash, you'll find it easier to make good business decisions. For instance, let's say your company is profitable but lacks cash. In that case, you need financial expertise. But if it's the other way round, the company has cash but isn't making a profit, you should focus on operational expertise instead. Look for someone who can assist you in reducing costs or generating more revenue. That's just one example. Understanding cash can help you with all kinds of things, leading to improved financial results. So be like Buffett and scrutinize your next statement. Learn the language of cash flow. Admittedly, cash flow statements can be pretty confusing, and even finance people have trouble sometimes. Part of the problem is the labeling. What do those categories really mean? Let's start with the basics. A cash flow statement shows the inflows, the cash moving into the business, and then there are the outflows, which is the cash moving out. There are three categories of cash, which refer to different kinds of activities. This is where it gets tricky. We'll look at each category in turn, so you understand what each one means and what you can learn from it. First, there's cash from or used in operating activities. This category refers to the business operations, such as cash received from customers and cash paid out in salaries. It includes all the cash the company has to spend to keep everything running. If the operating activities category shows a healthy flow, that's a great sign. It means the company is most likely profitable. It's one of the most important indicators of a thriving business with potential for growth. The next category on this statement is cash from or used in investing activities. In this case, investing activities means the investments the company makes, not the owners. An important subcategory to keep an eye on here is capital investments. This refers to the buying and selling of assets. For instance, if the company buys or sells a vehicle, it will be featured here. What can you learn from looking at the investing activities category? Well, it shows you whether or not the company is spending a lot of cash on investments. If it's a relatively high number, considering the size of the company, that suggests the management is optimistic and investing in future growth. The third important category is cash from or used in financing activities. This category covers loans, as well as transactions between the company and its shareholders. By the way, that includes investments from shareholders. It's classed as a financing activity rather than an investing activity. Confusing, we know. The financing activities category is also revealing, as it gives you a good idea of how dependent the company is on outside financing. Over time, you can see if the company is a net borrower, borrowing more than it pays out. That's the end of today's sharing. If you like our content, please give us a thumb up and share it with your friends. See you next time.